The program tonight is brought to you by Sheep Connect SA, and I'm the Pastoral Region Coordinator for that program. And Philippa asked me to mention the beautiful photo you see there is actually from our wool on our property. So it's a photo I took at our recent shearing. So just a bit of background about what is Sheep Connect. So Sheep Connect is an extension project run by Primary Industries and Region South Australia, looking for opportunities for producers to do practical programs where they can make positive change to their farm production and management practices. And that's focused both in the pastoral area, but also in the agricultural areas of South Australia. If you want to know a bit more about Sheep Connect, we have a Sheep Connect website, so sheepconnectsa.com.au, and you can also follow us on Twitter. We couldn't have this webinar tonight or part of the other programs that are presented by Sheep Connect SA without the support of numerous funding bodies. So we'd like to thank them, AWI, PIRSA, the Sheep Industry Fund, and the NRM Board, South Australian Arid Lands, and SA Murray-Darling Basin. Just a disclaimer, PIRSA, from PIRSA about liability or responsibility for any information that you may hear and is presented tonight. And it's my pleasure to introduce Mike Avery. Mike is the partner at Southern Aurora Wool and has been there for a number of years. He's got over 2 decades of experience in the wool industry and holds a number of industry positions, and they have included being a director at the Australian Wool Exchange for 6 years. And so it's my pleasure to introduce Mike to present tonight's webinar on forward pricing of wool.
Thanks a lot, Jodie. Well, we'll get into it fairly quickly because we've got a number of slides to go through. I'll quickly just give you a rundown of our company. Who we are, obviously, is Southern Aurora, and our job is to provide solutions in agricultural commodity markets. What we do, we offer brokerage in O2C products, but also in physical commodities and futures and options and foreign exchange. We also do development for Ryman on different O2C products, and we have a advisory structured finance wing. We're currently looking at a few other new products. They include cotton, revamping the current cattle contract. Also, lamb's not on there, but it should have said meat rather than cattle. Canola, we're looking at dairy and water at the moment. That's just a view of the guys and girls that are involved. We'll move on quickly and get into what we want to talk about is wool and forward pricing. I always like to start with a mission statement or something, and that is that the value of certainty is more important than the fear of lost opportunity. And I think that's an important place to start, because we are talking about forward pricing and certainty in a business that has a lot of volatility. Quickly give you a definition on what is price risk management and the types of contracts, and obviously that's key to what you want to hear tonight. Price risk management is all about margin management. It's not trying to pick the top of the market or anything that. If we could do that, life would be very easy. But it's about managing price, and because price is not necessarily the most important factor to a successful business, it's managing margin. And historically, wool, like most agricultural commodities, are very volatile, and that volatility makes forecasting, budgeting, and cash flow management difficult, and affects how a business is perceived and also its long-term sustainability. Hedging is a price risk management strategy that's designed to minimize exposure to market risk that's associated with changes in supply and demand and price. Hedging products such as wool forwards, they need to be simple, and hopefully at the end of this you'll see that they are, but they've got to be versatile in their application, and it's intended just to reduce risk and increase stability. The types of forward contracts, physical forwards, you're obviously been accustomed to, that come via the broker. We've got the OTC forwards that are based on AWEX MPGs, and that's what I'll be talking about tonight. And also, hopefully, if we have time, cover options, which you've probably been presented as minimum price contracts. The physical forward contract is where the grower contracts through his broker or an individual exporter to deliver their wool sometime in the future to agreed specifications. Now, as you know, with wool, those key parameters are micron length, strength, vegetable matter, yield, style, and all these present issues because of the relevant premiums and discounts that are attached and assessed by the individual purchaser. And that's where the downside in the physical forward, because the buyer needs to consider all these parameters and factor in his own premiums and discounts if wool falls outside those species. And the buyer needs to consider those risks involved and formulate a premium discount schedule accordingly. That differs from the Ryman over-the-counter product, is what we're talking about tonight, because it's cash settled, it's independent, it's based against the AWEX Exchange nominated price guides. It's the midpoint of the North and South MPGs. We do a few bespoke contracts based ex-West for some of our Western Australian clients, but the ones we're talking about tonight are the ones that are the screen traded, so the bids and offers are visible through an app or on your laptop. They're a wholesale product, so therefore it's a business to business, where the grower via their wool broker goes direct to the exporter and processor. There's no premium discount schedule attached because they're based against the MPG, and the premiums and discounts are ascertained at the time when your wool sold, not against that particular contract. So the grower sells at auction on the agreed maturity date and receives the marketplace premium discount, and the profit or loss is then applied to their total account sale, whereas they may have hedged 20 bales of wool against their 200 bale clip that they've sold at that time, and the profit or loss on that hedge of that 20 bales will be attributed to their account sale. There also is the ability, obviously, to buy that back, contract back should the occasion arise. Now, we'll just talk about the market dynamics and how the exporter is pricing. The exporter and processors are looking at the drivers of the market. And as a producer, I think that's what you also need to do when you're formulating your strategies, so you can regulate your returns just as the same as the exporter and processor do. And they use those forward hedging to manage their margins rather than margin their margins, as it says on the screen there, to reduce their risk exposure to adverse market movements. The exporter prices his bids based on their greasy sales or the expectation of those sales. And the export tends to trade both sides of the market depending on the changes in the supply and demand dynamics. They use it a way to increase their position, whether it's a bought or sold position based on where they're going. Processors, on the other hand, tend to come traditionally from just the buy side, where they're looking at that pricing basis, the sales of their tops, yarns and finished goods. Hopefully you're getting these screenshots in the same order that I'm seeing them. That's just a cut of the AWEX daily price guide, which comes out the evening after every auction, which gives you the price for the spot market of that day and the movement. So that's available through AWEX every sale day. What you will see on your app and your screen is what that market, the forward market, looks at, and that's just a screenshot that's up there now of what the major microns are. We do deal from 18 through to 30 microns. Not all the microns, but 18, 18.5, 19, 19.5, 21, 22, 23, 28, and 30. So a fairly wide coverage. Not always the best way to do things according to the purists, because you tend to move liquidity away from a standard. Those of you that have been in the business a long time will remember the original SFE, or Sydney Futures Exchange contract. Wool was the first traded contract on the futures exchange going back to the 1960s. There was only one wool type that was traded, and that was a 21 micron. Everyone, all growers, had to look at their own basis, and we'll get on to what basis means, against a 21. So if you were growing 19 microns, you only had a 21 micron contract to hedge. When we developed these contracts, the feedback from the grower side was that there needs to be more variety to reduce that basis, and exporters have taken that on board and are bidding accordingly. That's just a shot of what the app screen looks like, which obviously hasn't got the same detail. The one you're looking at is for 21 microns. Each micron has its own screen, so it hasn't got quite the same capability or the same depth that is applicable in the other screens. The other major contract that is dealt are options. Now, this is usually a topic that has people glazing over, because it's it can be presented as a very difficult concept. It really is fairly simple. It is very similar to an insurance product. What is a guaranteed minimum price contract, and where the price premium is determined according to time, a strike price, volatility, the current at the money price, which is where the futures price is for that time, and it is what is termed a put option, and what you probably have seen as delivered by your brokers as a minimum price contract. And that's what it is. It gives the grower the right, but not the obligation, to have a sold contract sometime in the future. And for this right, they pay a premium, and just like an insurance premium. The grower chooses the date, which is aligned to their projected auction date, and he chooses a price level where he'd like to take protection. Now, that price level is a big driver of what that strike price or premium would be. The seller of the contract, which is usually an exporter, will price the premium based on their view of the market, the relativity of the strike price to the current futures price, which is the at the money price, and the current spot. And they'll use the implied volatility and the time to maturity. Now, volatility is a complex thing. It is derived, well, actually the mathematicians that derived volatility, guys called Black and Scholes, got the Nobel Prize for mathematics, so that will probably give you an idea of how complicated it is. But it looks at the movement of price over time, and has a complex mathematical formula behind it to imply volatility to that market. When I was first looking at futures, probably 25 years ago, I went to a seminar and was asked what was the most volatile commodity that was traded on the world soft commodities market at the time. And fortunately, wool wasn't the highest volatile market. It was the second highest. The most volatile was onions. I thought, oh, well, at least I'm not working in onions. These models all incorporate these factors, and they guide the buyer and the seller to ascertain where fair value is. And where fair value is what the the market is predicting the insurance premium should be. And as you know, it's fairly evident, the more time you put into a minimum price contract, the higher the the premium will be. It's just like if you want to insure your car for 6 months, it is less expensive than insuring it for 12 months. And the same thing about the volatility. If you consider volatility like the incident of accidents, and so that's why if you are fortunate like myself to have young drivers in the family, your premium is much higher than if they're older drivers, because the occurrence of something happening, the volatility of chance of an accident is higher for them. So it's really not a complex concept if you break it down into that that idea of it being an insurance product. But the key and why some growers use a mixture of both options and forward pricing, outright forward pricing, is that the option has that upside for the grower, where they're just looking to guarantee against an adverse event, but are still in the market because they have the option and not the obligation to take up that sold contract. Whereas in an outright, you have sold a contract, so you have the obligation to deliver. So it's deliver the wool, but to contract that price.
Mike, if I might just interrupt you there briefly with a couple of questions. So we've got, is there a general percentage that you find growers contract of the total clip?
Yes, I was going to get to that, but we'll get to that now. Usually in a hedging strategy, and we'll talk about some of those strategies a little later, growers will start off at shearing, looking at their next season, and they'll either have price targets or they'll have time targets where they like to hedge forward, let's say 12 months out. They'll do their first percentage, and that might be as low as 5% or 10% of their clip within the first 2 or 3 month window, then another 10% in the 3 to 6 month window, and then another 10 in the 6 months to up to closer to the shearing date. And so they'll look at pricing 2 or 3 or 4 times along that curve to a total around about, I'd say, for those that are actively involved in the contract, they're looking at doing no more than about 30% of their clip. You know, they're getting that certainty around some of it, and whether that is to, of course, it's price driven, and we'll look at some of those drivers a little later. But if the prices are very, very high and well above their cost of production, they may choose to have that percentage a little bit higher, and where that sits in history. But in sort of an average market, you're looking around about 30%.
And Mike, you mentioned earlier with the no obligation situation. So if something horrendous were to happen in regards to some sort of natural disaster, fire, etc., you're not obligated to fill those contracts?
That for an option, yes. For an outright, no. You're going to be cash settled against that. You have a contract that says, I've sold for next December 20 bales, just like if you had a physical forward contract. You've got to meet that obligation. An option is you have the option. They're the main difference between the two. So let's say you bought a 21 microns are currently say 1887. So a 1700 option for December at 30 cents, then you would pay a premium of 30 cents, and you have the option of if the market was to fall below 1700 of triggering that option and taking that sold futures, because it's going to finish in the money. If it doesn't, then nothing happens. It's out of the money. You've paid your 30 cents premium or whatever it was, and you paid your insurance, nothing happens. It's a little bit like being happy that you insured the car, but you didn't have an accident, but you've got the insurance behind you. If you do have an accident, you've got there. In this case, the accident is that the market fell to $10 and you have a sold contract at $17. And so, but the bonus for the option is that should, say, the price stay at 1880, where it is today for 21 microns, then you will have not if you'd taken an outright forward contract at $17, then yes, you would get for 100% of your clip 1880 if the price stayed stable till December, but you would pay out 180 cents against that forward price. So in that case, you would have been far better taking a 1700 put option and paying away 30 cents. So the option gives you the opportunity to get the upside of the market should it stay there, and get the upside not just on your total clip, the 70 or 80% that's unhedged, but also on the 20% or 30% that you did hedge with an option. You also can be involved in that, having paid away 30 cents. So you're getting no deduction from your outright. Hopefully that explains it.
Yeah, that's great. Thanks, Mike.
It's a very isn't an easy concept to understand. Whereas when you're looking at pricing your clip with an outright forward sale, what you're doing is locking in some of your clip at that price and saying, okay, fine, and we'll look at some numbers that are on there later on where prices are forward, and so you're looking at basically hedging some of your cost of production against the forward market should there something happen. And I guess the next statement really sums up how I won't say difficult the process is, but of wading through or navigating the future, and that's Donald Rumsfeld, the American Secretary of State, once made a quote, and he said, "There are known knowns, there are things that we know, and there are known unknowns. That is to say, there are things we know we don't know, but there are also unknown knowns, and there are things that we don't know we don't know." Now, that might seem incredibly confusing at the time. Poor Mr. Rumsfeld was very much derided for saying something until people actually looked at it and thought about it. And if you relate that to the wool market, then we do have a lot of known knowns. We have current and historical prices in wool and competing fibres. We have current historical supply and demand. We have, via the forwards, a forward curve, and growers know their cost of production. So there's a lot of things we actually know, or we can get our hands on knowing. What the unknowns that we know are, here's a bit of a tongue twister, Mr. Rumsfeld, but they're the future supply and demand, and that's going to be impacted by weather, price, currency, global macroeconomics, government policy, these things that we know happen, but we're not so sure about. And that's what risk management is all about, by trying to wade through those things we know that we need to try and get out. And one Mr. Rumsfeld unknowns, which was about I think probably what was it, weapons of mass destruction. We had our own. Fortunately, it didn't impact Australia when the black swan events, which are these known unknowns. In 2010, we had Rift Valley fever in South Africa, and all of South African wool was quarantined by China. So all the demand for wool, or the supply, that was possible for out of South Africa was there was a moratorium, and the outcome we saw in Australia was quite advantageous to us through September of 2010 through to July, where you'll see a chart where the market went at that time. Now, not all of that was on that, but that was really something. It was a black swan event that pushed the price of wool up, because supply globally, although Australia is by and far the largest supplier of merino wool, South Africa was at that stage a significant supplier into Europe particularly, and into China.
And Mike, we've got a question here that's probably on a bit we were just discussing prior to, but it says, should the options be used closer to sale of wool, or as a tool to use throughout risk management strategy? And this grower's just said that it has been some advice that they've received from brokers.
If the volatility is not so high and prices are low, and the projection is prices may go higher, then options can be a very good value, using the word option again, choice for a grower to make, because of that fact that they can be involved in the upside of the market. At the moment, and as the question leading to the question, the closer you get to maturity affects it impacts on the premium quite significantly. So they will probably look more attractive closer to the shearing date than well into the future, because unlike an outright where the seller of the option, which is usually the exporter, he can't put that directly into his export book, not the full value of it. He can only put a percentage of it, and that percentage is actually quite significantly tied to the time factor. And the time is one of the big drivers of the cost of the premium. Just as I said, if you compare it to insuring a car, if you're only insuring for 6 months, it's half as cheap as 12 months. In options, that's pretty much the same. It's not exactly linear, but it's close to it. And so it may prove, from a price point of view, better to do it close. We did one very close to shearing the other day when the premium was very low and the strike was close to the market. But the grower was just he was only 6 weeks out from shearing. We were at 1900 cents, but the market very volatile for 21 microns, and he was looking just to take some cheap insurance. If you look at 20 cents on 1900 cents, it's fairly cheap as a percentage, just in case one of these black swan events or something impacted, whether it be currency or something, government policy. There's a fair bit of risk out there in the world of government, maybe not just our government, but if we could give an example of Mr. Trump, talking about trade embargoes or a trade war, that could impact us significantly, even though we're not directly involved. The kick on from something like that. So he was looking at a very short-term option, just so he was happy to pay away 20 cents because if the price of wool fell $1, he wanted to make sure that he had some cover over some big event. Highly unlikely, and when something's highly unlikely, just like in any insurance business, it is the cost of it is quite cheap. So I think for a grower, if the price is right, options are a good strategy. It's just liquidity an issue, and getting close to that fair value model. If the volatility and the time, then it's easy to calculate using a model to say what is a fair premium, and you assess, what, and that premium is driven obviously by price, and you might want to just say, okay, I'll take a well out of the money option, so a strike price well below where the current level is, but I just want insurance in case something outrageous happened to the market. But I would think on a ratio, we're probably doing 90% forward prices against about 10% of options. When the market was moving in an upward scale 12 months ago, that percentage was probably higher on the options. Exporters had a view that the market was going to continue up and were quite happy to write options at these current historically high levels. The writer of the option is really on a hiding to nothing if they're aggressive with their premiums, because we had a couple of instances in the last week or two, if we're talking on say 19 microns, where we saw the price decline over 6 selling days, well over 100 cents. Now, if an exporter had priced an option with a premium of even 50 cents, he's lost most of his premium, or not lost most of his premium, but the strike price had fallen below. He's got very little reward in that he captures the premium just like any insurance you pay it up front. He's captured say 50 cents premium, and he's seen the price start to fall back down to the strike level or past the strike level. So it's quite a risky proposition writing options at the top of the market, and they're currently priced accordingly. Hopefully that covers that question.
Yes, thank you, Mike.
No worries. And what we're talking about in all this data, it's out there and available through your local broker or through the National Council, AWEX, AWI, and ag consultants. It's just the job of the grower to press his brokers to make sure he's well informed. And I get a lot of that data through from the brokers, and they're pretty good at doing that and making growers aware of it. But if there's any particular stuff that growers need, it can be sourced.
This might be a good time to even tell our attendees about the handouts that we've got there in reference to Elders and Landmark and Quality Wool that they can download at any time they choose, and have a look at it later, just to refer back to what you were just saying there, Mike. Yeah,
and those that data I'm talking about, I do know are available on all three of those companies' websites that you've said. Those daily and weekly reports, they're all there, and not on a daily basis some of the other historicals. I'll just go through a few examples of why, or a visual really of why risk management is a necessary, or not necessary tool, but I think an advantageous tool for looking at managing margins. This is the longest dated chart that I could get, which was on this is 19 microns, but that dates back longer than Jody happily informed everyone I'd been in the wool industry. So that's almost, it's 42 years of data, and you can see the peaks and troughs that we've had over time. We'll go through a few others. If we look at a shorter time frame, this last decade, then you can see 18 microns has gone through the best part of 1,000 cents in that time. That's just a chart connects all those finer microns, and you can see the movement is in a pattern which we spoke about earlier, where there was only one micron that was hedgeable from the SFE, and the reason behind that is you'll see that the price movements for wool in concert with each other until you break them down. So you actually, all looks quite regular. But if you break it down, we'll discuss in a few minutes, because we haven't got a lot of time, about basis between the microns and how that can be used. But that's why there's hedging. The underlying product is more important than getting the basis absolutely right. Having said that, we now have a variety of products which can eliminate some of that that basis. Is from a historical point of view how to look at it. This is what's called a percentile chart, and it just gives you a reflection over the last. I've cut it back to 2 years because I think if we go back further, some of these numbers, this is the upward movement. So even in this short time frame, you'll see that we're currently sitting on some of these microns, or all of them except for 30 microns, in the 85 percentile or higher, which means that for 85% of the time, prices have been lower than this over the last 2 years. And if we will look at this over a decade period, then you'd find that the majority of the merinos are now sitting still in their 95 percentile band for the last decade. But I think that we need to reflect on, the last 2 years more importantly, because that's where we've set things. But it goes to show that even in that period, that there is downside from here to get even the average price of the last 2 years. For 18 microns, it's 250 cents under here. And when we get to a basis chart, you can see that it's just over 400 cents from the average on 21 microns, which is really very significant. And if we look at just some prices without the visuals for 21 microns, the average over the last 8 years is 1,270 cents, with a low of just under 900 and a high of 19. That's actually not correct. The high was 1938. Oh, that's yeah. So that didn't change that last 6 months. It broke that previous high. So we are talking about a volatile commodity and something that we need to address as growers, if in principle we're happy to accept the pricing of the work that we do for 12 months from one single day on that sale day. Or now, I know there's multiple occasions people sell across the year with more than yearly shearing, but the principle is that we should be looking at pricing the work done over the year on more than one occasion. It's just a clip of the indicative forward grid. You'll notice that it's still in quite severe backwardation, and a lot of that's been on the back of where we've travelled, especially on the finer microns, where it's come back over the last few weeks. So now, if we just talk about what are the key, I think, are the key drivers in trying to develop a strategy, and they're different for every enterprise, but they need to relate to the cost of production, risk appetite, and the impact, if any, on the cost of financing, because that's what the banks we're talking to are now looking at that volatility, especially at these levels, and they want to move risk around and are happy to price financing based on some strategy of risk minimization. We're actually getting close to time, so I'll run through these fairly quickly. They're just the type of strategies, and this is really just textbook examples of what happens in other commodities and what strategies are about, whether they're survival, adaptive, control, or hedging strategies. I spoke about basis, and I'd just like to explain that. It refers to the difference in the product that's being hedged to the underlying contract. So when we had the SFE contract, if you were a 19 micron wool grower, you were hedging 21. The basis was a difference between those two, and that chart we showed before, that they do move in line, but they actually do shift out when you break them apart. In the case of wool, it's the difference between your clip and the underlying MPG that you're going to hedge with, and for the exporter, the type they're delivering against that MPG. So the exporter doesn't deliver to China on 21 micron. The MPG delivers a type 55, and for a grower, their clip might be around 21 microns. It won't be exact, but it'll be a relative or a basis to that. And in most cases, it's best to minimize that basis and therefore hedge to that nearest MPG. But sometimes it's important to look at basis to see if you might get some strategic advantage. Now, this will give you an idea of what that basis can look like. This is just between two of the finer microns. And you'll see in 2011, that basis got to near enough 500 cents, and we almost got back that again. So that means the difference between an 18 micron wool and a 19 micron wool was 500 cents. So it was fairly important at that stage to be hedging your close enough to your production as you could. Whereas down in the lower section over a couple of years, especially in sort of 2014, when that basis got very, very low, then an 18 micron wool grower would be far better off hedging 19 microns when the basis is almost nothing. If that basis is out there in the forward market, then it's better to hedge the broader micron, because more likely than not, it will shift up from that basis, not down. It did get close to zero, but never touched zero. And we'll see that also in 21 microns, where that basis again got down to sort of 20 or 30 cents against 21. So at that stage, it would have been best to do 21 against 18 instead of that. Whereas at its peak in 2011, it got to 1,000 cents. So, and again, 21s, 19 to 21s, you'll see that it has moved violently, but it is now heading back in the other direction. I'm close to concluding, so I could have a few questions. The ongoing key, of course, in all of this is education. And just to sort of put it in broad terms, from the selling side, wool brokers that are participating in the Ryman market represent around 90% of the volume that goes through auction. So they are very active, but probably only half of those brokers are very active participants. On the exporting side, the same thing. Around 75%, exporters represent about 75% of the wool shipped, but the majority is only probably traded by about 25%. So we need education on both sides of that. And the real killer for wool, unlike grains, cotton, is that only about 2% of the underlying clip is hedged. And I think Jody asked Philip asked the question about, what is a normal strategy? Well, that's probably closer to 30% for an individual grower. So if you look at that, then individual growers, we're probably looking at only about 1% of individual growers or less using the contract, because the guys that are using it are hedging around about 20 to 30% of their clip. And liquidity for everyone is the key to delivering accurate and fair forward pricing. And I always like to finish with the same mission statement. We need to look at valuing certainty, which is more important than the fear of lost opportunity, because none of us can predict what the future is going to be. Thanks.
Right. Well, thanks very much, Mike. Also worth mentioning that we invited the brokers to provide the information in that handout section. So absolutely download them and have a look, and I suggest if you want any further information to contact your broker directly. I will, on finishing up, just firstly thank Mike for his very precious time, especially seeing we've pulled him back from Easter at Byron Bay to do this, which is very kind of him to give us his time. And along with Mike and Jodie, of course, we would like to, on behalf of PERSA and AWR Sheep Connect and Natural Resources SA Arid Lands, like to thank you all for attending. We hope you really enjoyed it. At the end, and we've got a couple of comments coming in, Mike, about the fact that it's been a great session and most valued, so that's fantastic. Anyway, so thank you very much again for logging on and attending, and we look forward to having you again at our next webinar.